So in our fourth part of the bond discussion, we'll talk about what's a callable bond, what's a make-whole calls, and what's a sinking fund. So let's look at an example. On this example, you see General Motors issuing a non-callable bond, but it is a make-whole calls. So what does it mean to be callable? We are buying a bond for the purpose of receiving the face value, receiving the coupons for the duration of the bond, meaning we're going to hold the bond for whatever the maturity is, and we're going to receive the face value. And while we're holding the bond, we hope to receive the coupons if there are any coupons. Now, obviously, the interest rates may change, the circumstances may change, but our intention is whatever. So for this one, for instance, it pays 0.2% yield to maturity. It only has less than a month in it. And we're okay with this, and we'll buy it, and then that's it. That's what we want to have. However, while we're holding the bond, if it is a callable bond, the company may actually call and buy the bond from us. Now, it could be that there's a call price. It could be that it is at the market value. Different call definitions are provided in indentures. So, but generally, it simply means that the company likes to refinance the bond, and usually it will be at our expense. Meaning, we probably will not be happy about this, because if it was really profitable for them, then they would not. If it was not profitable for them, then they would not do it. So if it is profitable for them, that simply means that it's not for us. Now, a lot of the times a callable bond will be a little bit more, a little bit cheaper, and therefore the yield will be a little bit higher. However, a callable bond forces you to take market risk or interest rate risk, which we're going to talk about in later lectures about bonds. But a callable bond can be called, and you may be forced to sell your bonds to the issuer. Now, because this is an inconvenience and sometimes exposes investors to additional financial risk, callable bonds are usually a little bit cheaper, and therefore the yield is usually a little bit higher. Now, make-whole calls is a little bit different. It can be that these bonds can be called, however, they have to make you whole. So, meaning that they have to pay you the net present value of all future expected cash flow. So, in a non-callable, you basically sell the bond. That's it. Whatever the price is on the bond as a callable value, call price, or the market price, depending on what type of call provision is included in the indenture, you sell your bond. Make whole calls, basically you receive all future cash flow that you wanted to receive to begin with. With a make whole calls, the net present value is paid to you. Now, again, there could be different indentures, different provisions about the make whole calls as well. So it's really important that when you're buying a bond, you should not assume anything as to if it is non-callable or make whole calls, that you should read the indentures and you should understand what their provisions as to the callable or make whole calls are. And these may be significantly different from one bond to the other, and it may be very important to you, and you may not like it. So notice that both of them will actually make you face additional financial risk. However, callable is a lot more disadvantageous, and make-whole call seems to be a little bit more advantageous for the investors. What does it mean if a bond is a sinking fund? It's not as common as a callable bond or a make-whole call, but a sinking fund simply means that part of the bond will be paid to the investors, to the bondholders, through the duration of the bond. So the fund will be sinking. The outstanding bond will be diminishing through time. And but again, when you buy a bond, if it is a sinking fund, you should read specifically as to the schedule of payments, and then calculate the present value based on that schedule. It could be that the sinking fund happens at the end, so its impact may be very little. It could be that it may have a very equal schedule through the years, and that the value of the bond may be diminishing as time goes by equally. It could be that the sinking fund may be at the pleasure of the company, pleasure of the issuer. So it's not very common, but especially in private placements, you could actually have a sinking fund clause that may be quite variable, and that would actually expose you a significant risk because you simply don't know when the company will be paying it back. So it might actually become very similar to a callable clause, even though it's actually referred to as a non-callable, but it is a sinking fund. So callable, your bond can be called and can be bought back from you. And make-whole calls, your bond may be bought back from you, but they will pay net present value of all expected future cash flows associated with the bond, dependent on the provisions of the bond, obviously. And a sinking fund where the bond, outstanding bond, may be paid off before its maturity. So the whole bond, instead of maturing at the end, will be paying sections of or parts of the face prior to the maturity in a sinking fund.